Hey, good morning, everybody. Mike Courtney here with Mass Mutual, and I'm joined by my good friend, Steve Parisi, President and CEO of IBC Global. Steve, how you doing today? We got a hot and humid August morning here in southeastern Pennsylvania. What are you up to today?
It is hot and humid. I went for a run this morning and I felt like I was running at the beach, and there's no
Soupy,
beach.
right?
There's no beach around here, so that tells you
Yeah,
something. Yeah.
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 What's going on this week? Anything good? Tell me what's up.
Yeah. Going to mile a minute as always, which is great. Things are moving. So, I mean, we did some adjustments in our marketing, just with the messaging to try and reach more business owners and more of that entrepreneurial mindset. Since forever, it's been kind of geared toward engineers and technical individuals. But so far, so good. I mean, I have fun with it, just learning more, but it's moving. How
You
about
guys are
you?
having a busy summer.
Yeah, but that's
Yeah,
fun.
awesome.
You?
Yeah, absolutely.
Mhm.
What's your, this year has been interesting from for me, from a competitive landscape type perspective. I know that your focus is very much on doing business with large, stable, tried and true mutual companies, which is why, you and I do so much business together. Um, what else do you see out there kind of coming and going? Like, there was big news with Ohio National earlier in the year, pulling out of our space and kind of leaving a lot of their advisors high and dry. Ohio National was a company that I always came in competition against. Their illustrations look great. Their comp was higher. I just could never get comfortable that that company was going to perform. And here, they're done. I feel like I've struggled with this over the years with really successful, seasoned financial advisors that I'm trying to do business with. I had a bunch of guys years ago who were selling MetLife's whole life portfolio, which looked great and the comp was nice. Mass was close to competing with it from an illustration perspective. And I remember saying to these guys, I just don't trust that MetLife is going to be in the whole life business for the next 50 to 100 years, consistently driving a dividend to the policyholders. They're not a mutual company. I just don't feel like this is sustainable. And I got brushed off. And, a couple of years go by, MetLife's out of the business.
Yeah.
And now those policies are all serviced by Bright House.
Correct.
And not to point a finger at it feels easy to point a finger at them because they're gone. But I was always surprised by some of these seasoned advisors' inability to kind of see past the illustration. I get it, and I know it's hard to make a sale, and it's not really how I make my living. So who am I to judge? But this space in particular, permanent insurance and whole life insurance, I feel like I'm, as a consumer, I'm not comfortable even entertaining smaller players for a variety of reasons. So, where do you stand on that? And like, how often does that come up?
Yeah. It comes up, not as much as it used to, but it certainly does. So, on the topic specifically about illustrations, because people we work with are interested in the cash value, the death benefit too, from a legacy
And
perspective.
they're
And
real detail oriented and
yeah,
analytical, right?
a lot of times, yeah, yes, yeah. Which would make you think, hey, each year let's review the policy and compare it to the prior year's performance. And is it matching up? Is it different? Why is that? And some people do like to look at that. And I do too on my policies. I'm not going to lie. But at the same time, what I look at, and I'll be very consistent, and our company will in our messaging with everyone, is when you look at cash value life insurance products, if cash accumulation, cash value is your goal, if the product's well designed with one of the four major mutual companies, Mass, Guardian, New York Life, or Northwestern Mutual, we've seen them deliver. And what I want to just dig into here is when I say we've seen them deliver, internal rates of return north of 4% on well-designed policies with those carriers, and I have not seen it from anyone else. Now, what I want to emphasize here is I'm talking about actual performance, not an illustration. So an
And not dividend history.
and not dividend history, correct.
And
that's
people think that dividend history is performance. And
yeah,
it's a marker, and it's definitely something that I'm always interested in looking at if you're looking at a company, just to kind of see where they've been and maybe where they're going, but it's not tracking policy performance.
It's not. And without getting too technical on that aspect, you can look at a time period where an insurance company, whether it's a small company or one of the major mutuals, had a consistent dividend rate. So the dividend did not adjust for, call it 5 years. But then we look at the original illustration over a 5-year period, and then the in-force illustration, the dividend rate, the funding, everything went exactly according to plan from the client's perspective, yet the actual values differed. They were a little bit less. And naturally, the question is going to come up. Why? Like the dividend rate from a consumer perspective, the dividend rate is the same from 5 years ago when I've started. So why did it change? Why do I have less money here?
If I'm a consumer, I'm thinking everything then should look exactly like the illustration that we looked at this year.
Correct, because I look at a dividend rate and think, hey, it should match up. But the thing is, and this is the unseen element, and I hate that because we always want to make things transparent for everyone, is there's other components that drive policy performance, cash value and death benefit growth. You've got mortality charges, insurance expenses that are embedded, or you can use the phrase baked into a whole life insurance product. And that's, without digging into that item, that is the main reason why I like to look at who's simply provided the strongest net internal rates of return consistently, and who do the ultra wealthy use, who do big banks and corporations use based on that historical data, not projections. Because we run into this, and I think you run into it every single day when you'll talk to a seasoned advisor that says, hey, I've got a case here, but company A, B, or C projects fantastic numbers long term, and they pay me a higher compensation. Like, why would I not go with this company?
Hard to compete with.
Yeah, because it provides more value on paper for the consumer, and it pays me a higher comp. So from a brokerage director, at your standpoint, now you're up against that competitive case where the agent's looking at it and saying, hey, this gives them more money, and it gives me more money. It's like a win-win. Why would I not do that? Do you want to comment on that before I keep going?
Yeah, only that I used to have, about this. I used to have a study, or I still have it, but there was a study done by Northwestern that compared each of the mutual companies' projections and performance from a cash value IRR perspective. And at the time, I was in a lot of competition with Penn Mutual, which is a great company. There's a lot of things that I like about Penn Mutual, but when it came specifically to whole life, I had hard and fast facts from this study that said Penn Mutual has this long track record of projecting on their illustrations the highest internal rate of return on cash value and delivering by far the lowest out of these 7 or 8 major to mid-major mutual companies. And I would show that to advisors who were looking at Penn and looking at Mass and comparing illustrations. No one cared. Nobody cared. They were getting paid more money from Penn. The illustration looked better. I don't know if there was a lot of people that I would talk to would just completely dismiss the study or be like, oh yeah, I know about that. I mean, it was a study done by Northwestern Mutual. So it's somebody who's got skin in the game. I guess maybe, I don't know. I didn't feel mistrustful about the study at all. It seemed to be something that was totally legit to me. I was always surprised. No one batted an eye. I'm not saying that the guys that I was talking to were just interested in comp. I think it was much more, this illustration's helping me close this deal.
Yeah, a lot of times.
I think that's it more than the comp.
Often it is. I mean, it's fear. If I'm going to show numbers that don't look as attractive and someone else sees higher numbers elsewhere, they could work with a competitor. So that's a fear. I used to have it when I was new in the industry. Um, here's how I look at that, and I do
Well,
know
why
this.
can't you also show the client as an example, like show the illustration, show them this, the study boiled down to one page that was,
Yep.
be like, look, just so you understand the landscape here. Maybe you can't do this with every client, but you got somebody who's putting in, 5 or 6 figures a year in premium. They're going to be a high net worth individual. It's probably a business owner or a doc or, somebody substantial that you want to do the right thing by. You don't want to be embarrassed 10 years down the road, I would think. Show them
Yeah.
the study. Say, look, this is how this is how these projections work. I don't know. Again, not my I was always just surprised.
Yeah, no, I mean you're hitting on a good topic because what I've seen to be the case is the biggest item of buyer's remorse, specifically around whole life insurance, is when someone is interested in a cash accumulation sale, so cash value, that's what they're interested in. They see different illustrations. They see a company, whatever company it might be, projecting fantastic values. They buy it, they put in whatever amount of money, and it doesn't perform. It under delivers. They had expectations set that they were going to have $1 million. Now they have $600,000. That makes it very easy for a competitor that's anti whole life, a traditional financial advisor, to say whole life is horrible, stay away from it, I told you so, which we all know that goes on both sides. Insurance agents do it to financial advisors, they fight with each other. But that's not my point. My point is the biggest item of buyer's remorse that occurs is when I get into a policy, it projects X, so I think I'm going to have this much, and then it doesn't deliver. And it really comes down to setting expectations and knowing who's going to deliver, or having a good sense of knowing who's going to deliver, I should say. Where I've seen people really get upset with whole life products is when they purchase with the smaller companies. I've seen this happen with a number of small companies. They buy that policy, it under delivers, they're looking at it and thinking, wait, I thought that I was going to have this much money. And then you've got a complicated problem that most agents don't understand too. They're funding it for a long period of time up to the MEC limit. They get an in-force illustration saying they're going to MEC in a couple years, where their original illustration said they would never MEC, and they didn't drop a term rider. It's because it under-delivered. It has a relationship to the death benefit and the MEC testing. But anyway, I don't want to get into that. Problems pop up there. And that's where consumers, their expectations were not set properly, and the agent didn't know, and they can't even get accurate information on it. So to avoid that, what I have seen to be just consistent and true, and this is what the elite do, the banks we work with, we set up two BOLIs over the past, 18 months or something like that. And 3 of the 4 major mutual companies were used in both of those transactions. And it's not because of the projections, it's because of here's what other banks do, here's what's tried and true, like it delivers. Why would I go mess around at the small company unless I'm at capacity as a BOLI, because there's limits as far as how much BOLI they can get with each company. But that's where they're going first because they deliver, like it's real there. So from a consumer standpoint, like here's what I've always seen. Those major mutuals have consistently delivered, and I'll set expectations now. Expect it to produce somewhere between that 3 to 5% range. If it's designed properly, I used to say 4 to 6, but we're in a low interest rate environment, and I think we're going to be for a little bit just as time passes. But that's really what I'd expect it to do when it's well designed with one of the top 4. And if you go with a smaller company that shows higher numbers, I'm not saying that that's bad, but what you're doing there is hoping that you're going to have higher numbers, but you're going to give up the sure bet, the sure expectation of what's always worked. So I'm going to go with something that might give me more, but has always delivered less. Questions on that? Does that make sense?
No, absolutely. Yeah.
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 Mm-hmm.
It's that sounds good to me. That sounds good to you. That sounds like tried and true and kind of best advice for a client. But Yeah, I mean, I've run into a lot of competition that looks like,
Get it?
kind of not fly by night companies. They're good companies, but you don't see a lot of wealthy, high net worth individuals running around with some small lower tier carriers whole life policy, and there's a reason for that.
So I'll give you a story, and I'll use the company's name as we're talking live, and if we decide we have to cut it out in the recorded podcast, we will. Was working with an individual, sharp guy. He's actually in the business, works for the second largest insurance company in the world, and he heads one of the top sales divisions. He's been in the business for a long time. He knows the industry. Sharp guy. He was in contact with another group looking at whole life insurance. He works with us and he puts in 400,000 per year. So I mean, he's got a significant size policy. It's not small. And the other group provided illustrations or let him know, hey, we prefer a small company, Lafayette Life. Lafayette Life's not a bad company. Look at their credit ratings, everything. I mean, they're a good company. But he heard that and he said, there's no way I'm going to flow over $2 million of my assets through that company. That's it. And he shut him down. And nothing against him. He knows the industry in and out, has worked for a number of insurance carriers, but actually digs into the data. It's like, I'm not doing it. He knows who delivers and who doesn't. And then I'm talking to him and he made another comment. He goes, I want one of the top. No, Steve, I want one of the best mutual companies to position my money. I want to set up my personal balance sheet like a bank. This is what I want because I know it's tried and true. And he went with a company that I've got products with personally as well, that their projections, they're one of the top four, they don't look the best. But at the same time, they've always delivered. And that's what I look at there too, because if I put someone in a product and it delivers, things are great. If I put someone in a smaller company that usually pays me at least twice as much, by the way.
Right.
Yeah, but it doesn't deliver and you're a consumer, who are you going to be upset with? I feel like it's going to be me, the company,
not the smaller company.
Bad taste in your mouth, and how I view like my company, IBC Global, just as we grow, like I want that AAA like agency rating. I want things to be set up properly. I want consumer satisfaction, and using the top companies gives me the best chance for that. Because if I start using small companies or getting into this whole like leveraged whole life thing where people will borrow huge amounts to fund policies, it's a little different than premium financing, but things that have not worked and I've seen just dissatisfaction with these other strategies, those are elements outside of my control that can just result in consumer dissatisfaction. So I look at it and say, hey, that can taint our ratings. If I want to view it that way, I'm not going to do it. We are doing exactly what the wealthy done. I've always done it. That was my background, designing policies for corporations. Like I've seen them do that and we work with them, they do it. So for me to branch off into smaller carriers and use them, and this is what I ask them every single time when they come to us and say, hey, write business with us, I need proof and not dividend history, not illustrations. I need proof of actual policy with the internal rate of return north of 4%, like what I have from the top four.
Yeah. And they can't, and I'm surprised that those companies can't produce that. I would actually think in that with that kind of stuff, I know we've talked about this before, that because they're smaller, they'd be a little more nimble and able to crunch data. But maybe not. Maybe they're dealing with antiquated systems and they really can't get their hands on that info, or maybe the info doesn't look like what they want you to see. Who knows?
Yeah, it could be a number of reasons, but I mean, there's a couple ways to look at it. One, give them time. One company I like where they continue to work, they're working with us, trying to get the data, so they've got the right mindset. But then I talk to some people, talk to my dad there, he'd just simply say, that means they don't have it. Like, move on. That's what he'd say. And I've been working with them for I don't know how many years now, trying to get data, a number of carriers. And like, if you can't get it, you can't get it. But when I say working with them, it used to be very intense. I would dig into policies. People send us their policies with other carriers. We review the IRR, and that's where I've gotten a lot of data, firsthand data, which is nice. But if we don't get it, like we don't get it. Now it's, hey, here's what we pay if you write business with us. I'm like, I need some proof. I'm not putting clients in these products until I have the proof.
I think something, another thing that kind of goes unmentioned is that, what I was talking about earlier with Met, like, I want to know that this company, I'm buying into something that I'm expecting to deliver a dividend to me every year for, the next 30 plus years. And I want to know that this company, I'm hoping this company is going to be around continuing to produce that kind of product and committed to me as a policyholder.
Mm-hmm.
And I don't know, I'm not comfortable with after everything that's happened over the last 20 years in the financial sector and the insurance business. You never really, you don't know what's going to happen. But God, I'm a lot more comfortable with putting my faith and confidence long term in a Mass Mutual or a Northwestern or a Guardian or a New York Life than I am anybody else. I mean, pick, I don't even have to name any other names, but as a consumer, I just think that has to be on your mind, longevity and strength.
Yeah, 100% agree. Just from the product and it delivering, and then depending what your focus is too. Like if it's, and I say this because everyone we work with is focused on cash value. If that's the goal, it's very difficult to look beyond the illustration. But looking beyond the illustration, company flexibility is big too. Some smaller companies have nice PUA flexibility features. Like, so that could definitely be a reason to go with them. So like that.
Well,
kind
it's
of
different
stuff.
too if you're buying term insurance or you're buying a guaranteed UL. I mean, all you really, as I can't say all, but like as a consumer, what will be on my mind would be, you want to make sure that this company is there to pay the claim. You're not concerned with anything else. And knowing what I know about this business, I know even if a company goes under, the state insurance department's going to take over and the company goes into receivership and historically that claim will be paid.
Correct.
It's much different ballgame if you're talking about cash accumulation and how you're going to use that policy down the road. So I'm in the same boat as you. As we stick with what's tried and true and what's proven.
And they've continued to deliver. I mean, we've got policies now, ones that I've put in place that are going into their 8th year. Some might be a little older than that, but they've performed, with the different major mutual carriers we've used. People are happy. I measure the performance and I'll use them in case studies sometimes, taking off the client's name and all that good stuff. But they deliver, and that's really what I look for. So I mean, one, it's getting that data from the carrier, and then two, it's doing it on your own. So when you've got historical policies, and that's where the design comes into play, like you can take any company, take Mask, you'll be familiar with this. I do see a big difference in IRR based on the design. If someone's focused on cash value, like you'll see the same individual could start policies at the same time. And if they're putting in 10 grand and one policy's all base, one's 50-50 and one's a minimum base premium, you'll see a difference on the IRRs.
Sure.
Which is interesting, but that's a whole nother conversation.
Yeah. Well, you know a little bit more about Mass Mutual case design than most people at Mass Mutual. So you're an unusual situation.
Oh, thanks. I have fun with it. All the company software. I'll show you my laptop one day. I've got just tabs of each insurance company's design software. That's my favorite thing to do with
that's what you like. Dig it apart.
Yeah, that's how we started, like the whole thing. Like I used to just sit down with clients one-on-one over a go-to meeting and design policies with them. And then we expanded since then.
Nice.
Yeah, but that's
all
it.
Right, well, let's keep up the good fight. It's always, I love competition and I love looking at different things. I get super frustrated when, cases don't go my way. Obviously, it's just competitive nature, but It is interesting seeing what else is out there, especially with the, now with the Section 7702 changes. How does that affect some of these other companies? I think, when we get into the end of this year, we're going to see, I think we're going to see some players kind of drop off. Maybe we see a couple kind of rising from the ashes and coming back into play. I'm always intrigued with, obviously, I primarily promote Mass Mutual, but I love seeing what else is going on out there and, where we can make more sales.
Yeah, I've seen some changes, some companies for the worse, some for the better, just with different like premium and PUA limits. But as we get more solidified from an informational standpoint, then we can talk about that.
Yeah, we'll do it that at closer to the end of the year.
Yeah, right on.
Yeah.
Cool.
All right, cool. Steve, have a great week. Anybody has any questions, feel free to reach out to me, Mike Courtney, or Steve Parisi at any time. Hope everybody has a great week. Steve, stay cool. I'll see you soon.
Likewise. Thanks so much, Mike. Take care.
See you guys.